Everyone talks about AI, Copilot, cloud, agents, $3 trillion valuation. But serious investors don't analyze narratives, they analyze structure. And structurally, Microsoft occupies a rare position in the AI stack. Let's break this down properly. Microsoft operates across multiple layers of the AI ecosystem. Infrastructure. At the base sits Microsoft Azure, one of the largest global cloud platforms. AI models require enormous compute power for both training and inference. A significant share of enterprise AI workloads already run on Azure. Infrastructure is not optional in AI, it is foundational. Model access. Microsoft has a deep strategic partnership with OpenAI, integrating GPT models directly across its ecosystem. At the same time, Azure enables enterprises to deploy alternative models that creates strategic flexibility and not single model dependence. Application layer. This is where the leverage multiplies. Microsoft embeds AI directly into enterprise workflow software. Microsoft 365, Dynamics 365, GitHub, LinkedIn. AI becomes truly powerful when combined with workflow data. Emails, documents, CRM records, code repositories, enterprise identity systems. Microsoft owns that enterprise context, and that matters. Very few companies operate across compute infrastructure, model access, enterprise workflow distribution, identity systems, agent integration. This structural positioning is rare, and Microsoft is actively reducing external dependencies across models and silicon to improve long-term AI economics and strategic control. In this video, we will analyze Microsoft's valuation and financials in one discipline framework. Link to the framework is mentioned in the description. Valuation. This is the first question I ask before investing. What valuation is the market currently assigning to this company? Before making any decision, I also look at the historical valuations at which investors have bought this company in the past. That gives the context. After all, that's how we make most of the buying decisions in daily life, right? We compare current price with what it has sold for before. To understand this better, let's look at this chart. Price to earning ratio is low. Earnings are increasing, and yet this stock is falling. So, the obvious question every investor asks, what's going on? Well, the company is investing heavily in AI. CapEx is increasing significantly. And when CapEx rises, free cash flow can temporarily decline. Margins may compress in the short term. Markets start worrying about returns on that investment. But remember, markets react to short term numbers, and great businesses invest for the long term future. The real question is, will this AI investment generate higher earnings 3 to 5 years from now? If yes, then short-term volatility may just be the price of long-term compounding. Total assets increased from $286 billion to $619 billion. PP&E grew from $44 billion to $230 billion. Goodwill increased from $42 billion to $119 billion. This is because acquisitions like GitHub and LinkedIn. AI CapEx transformed Microsoft into a hybrid software plus infrastructure giant. Returns remain strong. Returns on assets 20%. Returns on invested capital 27%. No asset bloat without productivity. Let's talk about liquidity. Quick ratio is 1.38 and debt to equity 0.32. This is not an over-leveraged growth story. Equity. This chart shows equity rising steadily while debt stays disciplined. Equity increased from $102 billion to $343 billion. Retained earnings grew from $24 billion to $237 billion. And that's when I knew Satya Nadella is basically my best friend. He doesn't know it yet. Shares outstanding declined, and that's when my one-sided friendship got stronger. Book value per share increased from $13 to $52. This is organic compounding and not delusion-driven expansion. Revenue increased from $125 billion to $305 billion. That's 15 to 16% CAGR. Operating margin 47%, net margin 47%, gross margin 68%. Margins expanded despite inflation and heavy investment. Microsoft's revenue is not dependent on one product. It is diversified across multiple durable engines. Azure, Office 365, LinkedIn, gaming, enterprise services, developer ecosystems. Deferred revenue doubled from $32 billion to $64 billion. That means recurring revenue base is strengthening. Earnings volatility is minimal. No dramatic collapse, no accounting red flags. Cash validates profit. Operating cash flow increased from $52 billion to $160 billion. Free cash flow increased from $38 billion to $77 billion. Cash conversion ratio is 1.3x net income. CapEx increased from $14 billion to $83 billion. AI spending exploded, yet free cash flow still positive. Free cash flow margin 25%. ROIC still 27%. This means AI investments are so far in control. Microsoft today is a high ROIC compounder, generating $160 billion in operating cash flow, producing $77 billion in free cash flow, maintaining 47% operating margins, carrying manageable leverage, allocating capital with discipline. Currently available at 25x earnings. It is not cheap, but it is not speculative either. This is not a deep value opportunity. It is a high quality compounder available at a fair price with a moderate margin of safety if execution remains intact.